first things first, okay? How does the actual inverse fair value gap indicator work? All right. Because many of you could potentially be seeing this for the very first time. What is a fair value gap? Okay, a fair value gap is essentially a price imbalance and market inefficiency, right? Okay, by definition, a fair value gap is a price imbalance created when price moves too fast, leaving unfilled orders or areas where slippage took place, essentially. Okay, the market seeks fair value, giving opportunity for buying and selling at every single price level in the market. So if you take a look at the NFP news release that happened this morning, there were certainly trades that didn't get filled at areas where there were pending orders resting because of how fast the market moved at 8:30. And we see this all the time with news. If you've ever experienced slippage with your stop loss, with your TP, with your entry even, that is essentially what a fair value gap is. It's when you have price moving so quickly through an area that it's not properly filling you at the price that it should be, given that you have a pending order set at a certain price. So at a glance, what it looks like, it's a three candlestick pattern. Okay, you have candle number one, candle number two, which is the one that creates the fair value gap, and then candle number three. This zone where you have no overlapping of wicks is the fair value gap zone. Now I could drop to a smaller time frame and maybe there is, you can see there was trading offered on both ends, and that wouldn't be as relevant of a fair value gap as a fair value gap that you can see on numerous time frames. That's like a little sidebar, but one maybe to, write down and take note of is that if you can identify a fair value gap on more than one time frame, that is going to hold more weight than just a fair value gap you can see on, I don't know, the 15-minute time frame, but no others. Okay. A true fair value gap is one that you'll be able to see on multiple time frames. That is basically put what a fair value gap is. And jumping back to the chart, an inversion is when you have, and you'll see that this indicator highlights fair value gaps. So here's a fair value gap. We'll just draw it out, for emphasis. An inversion is when price actually trades and delivers through. Okay, so far we're trading and respecting this fair value gap. An inversion is when we actually see candle closure through a fair value gap. Okay, this is what we call an inverse fair value gap. And so the way that this indicator works is every single time, the way that it's programmed, the way that this is coded, this indicator is coded to show and give entry parameters every single time an inverse fair value gap is created. So that is important to know because sometimes, we might look at the indicator and think, oh, on the 15-minute time frame, it's giving a buy signal. On the 5-minute time frame, it's also giving a buy signal. But if I go on the hourly time frame, it's giving me a sell signal. What is going on? There's a discrepancy with the indicator. It's broken. It's not working. Wrong. It's working. It's doing exactly what it's supposed to do. There are fair value gaps that are visible on certain time frames and that differ from any other time frame. So the indicator is programmed to whatever time frame you're showing and you have on your chart. It's going to show you the most recent fair value gap inversion, and it's going to give you entry parameters accordingly. So just to be very clear, it is programmed to do exactly that. So any single fair value gap that we have inversion with, which is, hey, here's an area where there was an imbalance, there was a fair value gap. There's two ways really to trade fair value gaps. One is you can look for a price to trade back to it and continue in the direction that the fair value gap was created. Or number two, we see price trade back to it, maybe slow down a little bit, but ultimately get candle closure through it, like what we get right here. This is candle closure through the top of the fair value gap. And we're actually looking for this to be an early sign of reversal. Hence why the fair value gap indicator, the inverse fair value gap indicator, it is a reversal indicator, giving you parameters in the opposite direction of the actual fair value gap and where it was printed. This is a bearish fair value gap. When you get candle closure through a fair value gap and an inversion is created, that is like the earliest sign of reversal. And you can look to take a trade in the other direction. Okay, so that's just to be very, very clear. You will see different time frames giving you different setups, but the indicator is working the way that it's supposed to. It's showing you on that time frame where the most recent fair value gap was, and more importantly, where the nearest and most recent inverse fair value gap took place. And so the entry parameters are going to be given accordingly. So that's how the indicator works. Okay, very simple. It's not a fancy indicator. This is not looking at anything other than where was an inversion, where did it take place, and then it's giving you entry and exit parameters accordingly. So if we take a look at, an example of a setup that I was looking for yesterday that played out absolutely beautifully. I mean, this was a textbook setup. And I'm going to hide the indicator for a second here because now we're going to move into how I personally use the indicator and how it's meant to be used. Okay. Because it's not meant to be just taken for face value and it's like every single setup you're just taking. No, that's not the best way to use the indicator. You could do that and have great success with that. All right. If you're using the indicator in the way it's supposed to be used, though, you're using it in confluence with other things that you are identifying yourself personally before even toggling on the indicator to be visible. Okay. In the indicator section in the top left corner of your chart, you have the ability to toggle it to be visible or invisible. This is definitely worthy to write down these 3 steps. Okay. Step number 1 is identify trend. Are we in a bullish environment? Yes. Great. More recently, we've been in a consolidation. Number 2, where is the money? This is in regards to liquidity. Where are there areas of liquidity? Acknowledge and identify those areas of liquidity. So if I'm taking a look at this chart, this is Tuesday morning, it's 8:30 a.m. Okay, I'm looking for an opportunity. I'm hungry. I'm on the charts and I'm hungry. I'm ready to feed my family with today's trading. Okay. I got to ask myself, where's the money? All right. I got to ask myself, where's the money? And I need to identify it on my chart. So if I'm taking a look at this, what is liquidity? By definition, it's swing highs and swing lows. We'll save that for another lesson because we don't really have time to break down what liquidity is. It's essentially any area that you would mark out as an area of quote unquote support or any area you would mark out as quote unquote resistance. There is liquidity above resistance and there's liquidity below support. So at a glance, right, a bunch of people are probably selling from this area of quote unquote resistance and buying from this area of quote unquote support. What I'll do is I'll identify these areas of liquidity. I'll draw a line and I like to put a little dollar sign, on my preset lines. This is kind of how they look. Okay. For those of you guys that don't know, you can take a tool. This is a trend line tool. Go to the text. You can add a, dollar sign or, whatever you want. I'll put an X for liquidity that's already been captured and you can save it as a template. So I have a bunch of templates saved. I can go save as liquidity, buy side, right? Because the dollar sign is on the top. That's for buy side liquidity. And you can save these templates, very simply, very easily. A lot of people don't even know that. It's a very, basic thing, but it's, fundamentally important to know. So maybe some of you didn't know that and now you know. But that's the second thing I'm doing. Number 1, I'm identifying trend. I know that we're in a bullish environment. Number 2, I'm asking where is the money? Number 3, where are the POIs? Okay, what is a POI, Donnie? Well, a POI is a point of interest. These are things that I teach, in some of my bootcamp content that you guys will have access to when the Smart Money 2.0 bootcamp comes out. A point of interest is an order block. A point of interest is a fair value gap on a higher time frame. A point of interest is something that you can identify and acknowledge as an area where price is likely to react from. So when we take a look at the chart that's on screen, this is gold yesterday morning. I know we're in a bullish environment. I've identified a couple areas of liquidity here. Okay, technically this high too. You can look at this high as well. There's liquidity to the buy side above these highs. There's a lot to the downside. I take a look at this and I think to myself, we have a lot of consolidation in this area, and there's tons of liquidity that's building up beneath these lows. And normally, what are we taught as a basic rule of thumb as traders? You want to buy low and sell high. Well, I don't really want to buy at a premium. This is like the highest we've been on gold and, since Friday, right? So sells would actually be favorable in this instance just for a retracement, understanding that the higher time frame trend is bullish. What point of interest do we have? There's a fair value gap here that was wicked through. And, nonetheless, we could have potentially marked up as a point of interest. Next, once I've identified this is on the higher time frame. This is on the 15-minute time frame. You can look at this on the one hour time frame. The only time I'm actually going to toggle on the indicator is from a smaller time frame, number 1, Okay, these are the first three steps that we're doing. Next, and these we're just going to do bullet points. I'm only using the indicator on smaller time frames. You can use it on higher time frames. There's nothing wrong with that. But for me personally, and the way that the indicator is meant to be used is from smaller time frames. So that's like the 1 minute, 3 minute, 5 minute, 1 minute to 5 minute time frames. I'll look for entries when liquidity is captured and when trading inside a higher time frame POI. Let's break this down. Okay. So this is a 15-minute fair value gap. We have areas of liquidity here. Okay, where's the money? That's the question we're asking ourselves for where's the money? Where's the liquidity? So I'm only using the indicator on smaller time frames, ideally the 1 minute, 3 minute, 5 minute. That's kind of the range that I'm looking to use the indicator on. And I'll only look for entries when liquidity is captured and slash or when trading inside a higher time frame point of interest. So this is a higher time frame fair value gap on the 15-minute. If we were to trade up into this, we're capturing liquidity, and I would look for an inversion in this area to take sells to then target the other side of liquidity. Very simple. I mean, this is the way I trade all the time. Now, as we play out price, we're going to drop to the 5-minute. Okay, what I would do in this scenario is the same thing as what we've just done on gold. All I would do is set an alert at these highs, and I would set an alert on these lows. That's it. I'm not going to stare at the chart. There's no point. No point in staring at a chart because you're going to force an opportunity or force a trade that isn't actually there. And remember, the inverse fair value gap indicator is always going to give you entries based off the most recent inversion. But to find the highest quality setups, I'm following these steps. I'm identifying trend. I'm identifying where the money is. I'm identifying where the points of interest are. And then I'm only using the indicator on smaller time frames, 1 minute, 3 minute, 5 minute. And I'll look for entries only if and when we've seen liquidity captured on a higher time frame or we're trading inside a higher time frame point of interest. Okay. So I'm not staring at the chart leading up to these highs getting taken. I'm only coming to the chart when I get that notification that, hey, price traded above these highs, which you'll see as we play out price here on the 5-minute. We're chilling, we're chilling, we're chilling. Imagine I was staring at this thing. I would have been bored for 45 minutes until we finally take these highs out. Look at that girthy candle. What a word, girth. Look at the girth on this candle right here. Okay. 5-minute candle trades 150 pips into this fair value gap, captures both these highs. Okay. Remember, I'm only using the indicator on smaller time frames, 1 minute, 3 minute, 5-minute, when I've seen a liquidity capture and or because sometimes they don't happen together. In this case, it's happening at the same time. And or we're seeing price trade into a point of interest, either liquidity capture or point of interest is being traded into. In this case, we have both. Okay. Old fair value gap. Again, this wick is kind of irrelevant because it wasn't here on every single data feed. It wasn't there on PU Prime to my recollection. Now I'm dropping in the 1 minute because the 1 minute will always give you an inversion first. If you want to write this down, 1 minute inverse fair value gap entries will always come first. Okay? Well, not always, like 95% of the time. You will see a 1 minute inverse fair value gap happen first, then 3-minute inverse fair value gaps, followed by 5-minute. Okay? And this is always going to be dependent on how price is printing, So here we are, 1 minute time frame. We have relatively equal lows on the 1 minute, just throwing that out there. Okay, nothing, not that we're looking to target 1 minute lows, but I like to look for reasons for price to trade to certain areas. And we're trading inside this higher time frame point of interest. Now I'm toggling on the indicator and I will literally watch price develop. I will watch price print until we get an entry given with the indicator outside or inside of this point of interest. Okay. So taking a look at this as we're printing, so 1 minute time frame, we will always give you an entry first. So you can see these are the entry parameters that are being given. I'm going to make this a little bit easier to see. So here we have a 1 minute inversion inside the point of interest after a liquidity capture. Okay, you can see it's labeling the inverse fair value gap. There's a fair value gap created here. Price wasn't overlapping wicks. We traded through it a couple times. We didn't actually get candle closure through it until right here. That's where the entry parameter was given. It's then going to give you 2 take profits based on the risk to reward ratio that you've set in settings. So take profit settings by default, you're going to have two take profits toggled on. You can choose to toggle on a third one if you'd like. And the risk to reward ratios are going to be set by default as 1, 2, and 3. This is something you can adjust in the settings. With V2, you can adjust this in the settings. If you want to change this, you're absolutely welcome to. But with the inverse fair value gap indicator, you're not looking for ridiculously high risk to reward ratios like 1 to 3, 1 to 5 for first, two take profits. It's different than, other strategies and styles. It's a higher probability strategy with a higher win rate when you have a lower, risk to reward. Is really good win rate actually with a 1-to-1 risk to reward, 1 to 2 risk to reward, also fairly solid win rate. So this is the first inversion that's given on the 1 minute. 3 minute, if we take a look at price, there's not even anywhere close to an inversion back here. The most recent one was a buy setup from back here. 5 minute, same thing. Again, you will always see the 1 minute give you the inversion first. So here we have that inversion. All right. If we're taking this trade, which this is a totally valid and relevant and ideal setup to take. I know it might be a little bit hard to, see something like this, like a very bullish move like that, and then just get an inversion and take a sell from there. It can be a little bit intimidating. But again, what is the context? The context is we're trading inside of a 15-minute time frame fair value gap after having captured two relevant higher time frame highs. So the second that we're seeing an inversion, this is your evidence of, hey, this is probably a good time to take the sell instead of just taking it, blindly out of the higher time frame fair value gap or, taking it from the higher time frame. You're going to get a better entry, a better risk to reward, a better stop loss size, taking a sell using the inverse fair value gap indicator on the smaller time frame when price is trading in the higher time frame point of interest. I really hope this is resonating and making sense. I really hope so. And I'll get some feedback from you guys in the chat in a second. As we play out price, we consolidate here for a little while. The first entry is taken out. I'm not losing confidence in the setup. I'm not feeling any type of way about it. There are instances where the indicator will have one or two invalidations prior to the actual move. Stay with me. Okay, so first setup, we get invalidated. You can see that there's an X here. That means that the SL was traded through. This is an invalid setup. All right. I'm going to continue to watch price develop. We have, this is a weird one, another inversion that's given right here. Okay. And if we look on the 3-minute time frame, this is, that was like a last up candle prior to, a pretty aggressive move lower. 5-minute, you're going to see something fairly similar here. 1-minute time frame, this is like a very strange data feed. Where we see a little bit of a wonky inverse fair value gap here. You can hardly even see it. On a different data feed, it's a little bit clearer. But nonetheless, it's giving you another indication for shorts. Now, you might look at this and be like, well, Donnie, I just took an L on this setup. Why would I try and, take the same setup here? And, what's the likelihood of it being any of a different scenario? And that's, understandable why you might have that mindset. The thing with the inverse fair value gap indicator is you might have one or two setups that are invalid prior to that absolute banger of a setup that ends up trading and playing out directly to TP almost immediately. Okay. Again, this is inside a higher time frame point of interest, so there's reason for us to be taking these setups. First one was invalidated. So what? On to the next one. When you learn to move from one setup that was an L to the next setup and completely disregard and not let the previous setup influence your decision-making process, that's when you'll really find consistency and profitability. And this is an instance where this is put on display because the first setup was invalidated. Second setup is given here when we get another inversion, not like the best, most sexy example of an inversion. Maybe the 2 minutes a little bit different. It's not any different. Okay. But nonetheless, price sweeps this high. We get inversion. There are your entry parameters. And as we play this out, you'll see that we smack both TPs directly after getting this indication. And not only that, we end up taking those relatively equal lows on the 1 minute. And this thing absolutely melts all the way down to the lows. Okay. We end up getting a bit of a pullback and then boom, we end up smashing and taking out all four of these relatively equal lows. Okay. 5-minute time frame, here is your inversion entry. So if you're like, okay, these 1 minutes are not always the most consistent. We had one back here, we had another one that got invalidated, whatever. I want to wait for the 3 minute or 5 minute. You can totally, totally do that. And if we take a look back here, you'll notice that there was an inversion setup given on the 3 minute time frame right here. Okay, so when this 3 minute time frame got inverted, a bit of a bigger stop loss, but TP1, TP2 at 1-to-1 and 1-to-2 risk to reward respectively. Smashes TP1 immediately. A little bit of a pullback. You'll notice that again, the indicator is programmed by default to always show you entry parameters of the most recent setup. But under display limits, if I want to go back and see my previous setup, I can increase this to show the last two and to hide the most recent one. So I can focus on the ones that I actually want to see on my chart. This is a huge upgrade from the last, V1 of the indicator. And so this is a setup that we had from that particular 3 minute time frame inversion. And again, what are we targeting? Obviously, the indicator by default is giving 1-to-1 and 1-to-2 risk rewards for TP1 and TP2 respectively. But for me, I'm always looking for liquidity to capture, and we take out every single one of these lows after sweeping these highs, and we also sweep this high as well. Prior to actually getting that move. So really, really solid setup. We got it on the 1 minute first, we got it on the 3 minute second, and we got it on the 5 minute thirdly. Okay, which makes sense. Usually it'll be in that order for the setup. So yeah, that is an example of how I would use the indicator. Again, I'm looking at and I'm considering these points that we've written on screen. I'm not just taking the setup blindly based off the parameters that are given, because guess what? The indicator is going to give us parameters every single time the market creates an inversion. The three questions I'm asking myself, or the three things I'm looking at and considering, is number one, I'm identifying the trend. Number two, where's the money? Number three, where's the point of interest? This is on the higher time frame perspective. Okay. Next, I'm using the indicator on the 1 minute, 3 minute, 5 minute, the smaller time frames. And I'll only actually look at the indicator once we've seen some form of a liquidity capture or we're trading inside of a higher time frame point of interest. In this instance, we had both. We had liquidity capture and we're trading inside this point of interest. And we ended up sweeping this high as well when the actual, inversion ended up being an absolute banger. And ideally, I want to look to see, do I have liquidity I can target? Is there liquidity? Is there an area where I can see price trading to that will be the magnet that's drawing the market to a certain area, a certain level? And then again, a couple points to consider. When you're on the smaller time frames, you can start by looking at the 1 minute and then look for follow-up inverse fair value gap entries on the 3 minute and 5 minute. You will find more consistency. Huge point here, write this down. You will find more consistently profitable setups on the 3 minute and 5 minute time frame than you ever will on the 1 minute. But, huge but here, okay? Thick but here, okay? The 1 minute time frame will give you the earliest entries and sometimes the better setups. There's just a little bit less consistency, a little bit less accuracy, and this is a prime example of that. Okay, remember, before we ended up taking that banger of a sell, in this particular example, we had a losing trade. The first attempt was a loss. The second attempt, though, absolute banger, and this second attempt came well in advance and well before anything presented itself on the 3 minute and anything presented itself on the 5 minute. Okay, our entry on the 1 minute time frame was up here. Our entry on the 3 minute and 5 minute time frame was down here, almost 200 pips lower. All of that to say, the indicator is really, really solid for timing entries. It's really solid for just taking it for face value. In some cases, when you have entry and SL and TP parameters, you can take it just for face value with those parameters. But my preference is actually to take one position just to focus on these parameters, and a second position, especially in this kind of a scenario where it's higher time frame point of interest, smaller time frame entry, to then target the higher time frame lows. So I'll swing this thing for, in some cases, well beyond just a 1-to-2 risk to reward. So that is the thorough kind of breakdown of how to use the indicator, how to access the scanner. You can go into PrimeVerse and look for the inverse fair value gap beta section, and then just fill out a form in here. And then within 48 hours, you'll have access to the V1 version, and then you'll automatically be added to V2 once that goes live for everybody.